Today, we expose what the Bank of England, the major lenders and the government are quietly trying to keep out of the headlines. Right now, in May 2026, an estimated 1.4 million UK households are walking off a cliff they didn't know was there. Their fixed-rate mortgages, locked in during the historic low-rate era of 2021, are expiring throughout this year, and they are about to remortgage onto rates nearly 3 times what they're currently paying. This isn't speculation. UK Finance has confirmed that approximately 1.8 million fixed-rate mortgages are set to expire by the end of 2026, with around half of these being 5-year fixes secured during periods of ultra-low rates. The Bank of England's April 2026 Financial Stability Committee record went further still, confirming that around 1.3 million more UK households are facing a jump in their mortgage payments by the end of 2028 as a direct result of the Iran war, bringing the total number of households facing mortgage cost increases to a staggering 5.2 million. The numbers are brutal. In 2021, 5-year fixed mortgage rates below 2% were widely available. Today, the same borrowers are being offered remortgages at 5.5% or higher. Compare the market estimates, the jump in rates could add as much as £2,124 a year to some households' mortgage bills. For borrowers who let their fixed rate lapse and roll onto their lender's standard variable rate, currently averaging 7.58%, the payment shock is even worse, with average annual mortgage costs rising by £4,860. That's £400 a month, every month indefinitely. We've spent days digging through Bank of England financial stability reports, UK finance forecasts, Office for National Statistics data, and lender pricing updates to bring you the real picture of the 2026 mortgage crisis. What we found is a slow-motion disaster that's already begun, and most homeowners have no idea it's coming for them. But before we get into it, if you have a mortgage that's expiring this year, if you're on a tracker rate that's been climbing, or if you're a first-time buyer trying to get on the ladder right now, hit that subscribe button. We're British Front Media, and the big lenders won't warn you about any of this. They make money when you panic and accept the first deal they offer. We have you. Every subscriber, every share, every comment forces this information higher up the algorithm. So subscribe, drop a comment with your situation. Let's expose what's really happening. The trigger event. On February 28, 2026, US and Israeli forces launched military strikes against Iran. Within 4 days, on March 2nd, Iran announced the closure of the Strait of Hormuz, the strategic waterway through which 20% of global oil supplies pass. The resulting energy disruption was described as the largest energy supply disruption in recorded history. Brent crude surged past $100 per barrel. Qatar Energy declared force majeure on LNG shipments, and the UK mortgage market, which had spent the previous 6 months pricing in interest rate cuts, was forced into immediate reverse. The transmission was instant. 2-year gilt yields rose over 40 basis points in a single week. Swap rates, which lenders use to price fixed-rate mortgages, surged to multi-month highs within days. Within 11 days, over 1,500 mortgage products had been withdrawn from the UK market. HSBC, Nationwide, Coventry, Principality, Skipton, and TSB all repriced upwards. TSB alone imposed a 50 basis point blanket hike. Some lenders repriced more than once in the same week. The damage to mortgage rates. Pre-conflict, the average 2-year fixed rate sat at 4.82% and the average 5-year fix at 4.94%. By mid-March, average rates had climbed above 5%, the highest level in 7 months. By April, the average 2-year fix had pushed to 5.78% and the 5-year average to 5.68%. For a borrower with a £200,000 mortgage over 25 years, the jump from 4.8% to 5.5% adds around £90 to monthly payments, close to £1,000 a year. For larger London mortgages, the additional annual cost runs well into 4 figures. The Bank of England's painful pivot. Before February 28th, financial markets were confidently pricing in further Bank of England rate cuts during 2026. After the strikes, they're now pricing in an increase in the base rate by the end of 2026. The Bank of England held rates at 3.75% at its March 19th meeting, when a cut had been widely expected. UK inflation has begun rising again, hitting 3.3% in March, up from 3.0% in February. And following the April 30th rate decision, traders are now predicting 2 interest rate hikes in 2026, not cuts. This is the mechanism that's about to trap 1.4 million homeowners. They were promised cheaper rates. They held on through 2024 and 2025, hoping their remortgage deal would land in a cutting cycle. Instead, they're now landing in a holding and potentially rising cycle, just as the global economy absorbs the energy price shock from the Middle East. The 1.4 million household problem. Let's break down exactly who is trapped. The Office for National Statistics first identified the 1.4 million figure as the number of UK households facing the prospect of interest rate rises when they renew their fixed-rate mortgages this year, with the majority, 57%, having locked in at rates below 2%. Layer on top of that, the Bank of England's April 2026 update confirming an additional 1.3 million households now facing payment shock due to the Iran war. And you arrive at one of the largest single-year refinancing events in modern UK history. UK Finance's 2026 forecast confirms that around 1.8 million fixed-rate mortgages will mature in 2026, with external remortgaging volumes expected to hit £77 billion, up 10% year-on-year, and a further £261 billion of product transfers. That's nearly £340 billion of mortgage debt being repriced in 12 months, much of it onto rates substantially higher than the borrower has ever paid before. The 5-year fix trap. The worst hit segment is the cohort of borrowers who took out 5-year fixed-rate deals in 2021. Around 971,105 5-year fixed-rate regulated mortgages were taken out in 2021. The majority were locked in below 2%. The average of the lowest 5-year fixed remortgage rates across the 10 largest lenders now sits at 3.89% in January 2026 and has climbed substantially since the Iran war began. For a homeowner who fixed at 1.9% in 2021 and is now remortgaging at 5.5%, the monthly payment increase on a £250,000 mortgage exceeds £400. Annualised, that's almost £5,000 stripped out of household budgets. Money that previously went to childcare, energy bills, food, or pension contributions. The standard variable rate trap. The borrowers who do nothing face an even worse outcome. When a fixed rate ends, the loan rolls automatically onto the lender's standard variable rate. The average SVR now sits at 7.58%, nearly double the Bank of England base rate. Around 540,000 borrowers, about 6% of all UK mortgage holders, are already on SVR. And that number is set to rise sharply as confused or overwhelmed homeowners fail to remortgage in time. With around 4,384 mortgage deals coming to an end every single day, the SVR trap is now catching tens of thousands of households a month. The economic backdrop, and it's getting worse, not better. UK GDP growth forecasts have been cut, with Oxford Economics and KPMG now expecting UK GDP growth of well under 1% in 2026. A slowing economy means rising unemployment. The UK already imports around 44% of its energy, making it more vulnerable to global energy shocks than the US or Norway. Inflation is forecast to remain sticky, which means the Bank of England has limited room to cut rates even if it wants to. And household savings buffers, which kept the country out of arrears during the 2022 mortgage shock, have largely been depleted. The result, according to economic analysis, is that the share of UK loans in arrears will rise over the next few years, though analysts believe it will remain below the levels seen after the 2008 financial crisis, when 216,400 mortgages were in arrears and 48,900 properties were repossessed in a single year. Who's most at risk? The borrowers in the most danger right now are 6 clear groups. First, anyone whose fixed rate ends between May 2026 and December 2026. Second, anyone on an interest-only mortgage approaching the end of term without a clear repayment plan. Third, first-time buyers from 2021 who used 5 to 10% deposits and now have negligible equity. Fourth, buy-to-let landlords whose mortgages reset onto a rate higher than the rent the property can charge. Fifth, anyone in a high loan-to-value bracket, typically 85% or higher, who is now seeing tighter lender criteria reduce their refinancing options. And sixth, anyone in prime central London where property values have fallen 12 to 13% in a single year, meaning many borrowers are sliding into negative equity at exactly the moment they need to remortgage. What lenders are actually doing? The major UK lenders, Santander UK, Barclays, Halifax, Lloyds, NatWest, HSBC UK and Nationwide Building Society, have all implemented mortgage rate increases in recent weeks. The Mortgage Charter, introduced under the previous Conservative government, still applies, meaning lenders must give a 12-month period from the first missed payment before seeking repossession without consent. But the protections won't help a household that simply can't afford the new monthly figure. Lenders are being told to offer term extensions and switches to interest-only as forbearance options. But these are sticking plaster fixes that increase total lifetime cost dramatically. 3 rules for surviving this. If your mortgage deal is ending in 2026, do these 3 things now. First, secure a rate now, even if your fix ends 6 months from now. Most lenders allow you to lock in a remortgage offer up to 6 months before completion, with no early repayment charge if you switch during the last 3 to 6 months of your existing fixed term. If rates fall further by then, you can usually rebook onto a lower rate. If rates rise, as the swap market currently suggests, you're protected. Second, use a whole-of-market broker, not a direct lender. Direct lenders only sell you their own products. A broker has access to the entire market and is much more likely to spot the best fee versus rate combination for your specific loan size. A slightly higher rate with a lower fee can be cheaper overall than a headline low rate with a large upfront product fee. Third, if you're already in financial difficulty, contact your lender before you miss a payment. The Financial Conduct Authority and the Mortgage Charter require lenders to discuss support options, including term extensions, interest-only switches, and payment holidays, long before any repossession proceedings can begin. You have rights, but only if you engage early. The brutal truth. The UK mortgage market is now caught between 3 forces it cannot control. The Iran war has disrupted global energy supply. Inflation is sticky. The Bank of England can't cut. Swap rates are stubbornly high. And 1.4 million households are about to remortgage into the most expensive borrowing environment they've ever faced. Not because of anything they did wrong, but because the global economy shifted under their feet between February and May 2026. For most, the payment shock will be manageable but painful. For a significant minority, perhaps several 100,000 households, it will mean cutting back hard, dipping into savings, or in the worst cases, falling behind on payments. And for the small group whose finances were already stretched, 2026 may end up being the year they lose the home. If this video opened your eyes to what's really going on in the UK mortgage market, hit that subscribe button one more time. Drop a comment telling us when your fixed rate ends and what your lender's currently quoting you. And subscribe to British Front Media, because we're doing this every single week. New investigation, new expose, new truth the banks don't want you to hear. Until next time, read the data, question the headlines, and protect your home.